ETFs that offer private credit exposure are growing, but are they offering a good deal? This is Inside ETFs, and we're talking private credit. This is a $3 trillion market that used to be reserved for high net worth individuals, but as some of the most hyped companies of the moment, from OpenAI to SpaceX, have yet to go public, the ETF industry is increasingly offering exposure to private markets. The problem is that those markets rely on money being invested for the long term, while retail investors want liquidity. Paisley Nardini is a multi-asset portfolio manager at Simplify Asset Management. Paisley, asset managers are clearly keen to tap private markets, aren't they? But how much are they able to offer meaningful exposure?
Yeah, well, thanks for having me. I think this is a wonderful topic to be discussing, especially with private credit being in the news in the last few weeks. And I think bigger picture is thinking about the democratization or just the access point of these markets, to your point, that have only been available to high net worth. And I think we always have to be thoughtful and we have to be cautious as to bringing these investments down market. And there has been this proliferation or growth in this space. And I do think this is helpful, especially in the high net worth space or in the accredited investor, to have access to these points. But specifically within the retail investor, there needs to be some educational component. And that's where asset managers like Simplify, who have launched strategies, private credit strategies and ETFs, can help investors understand what they are getting and what they're not getting, because you don't always get to have your cake and eat it too.
So what do investors need to know?
First and foremost, I would say from a liquidity perspective, when you are wrapping any investment strategy in an ETF, you're going to have daily liquidity. And that's one of the key benefits when investors are investing in, say, private markets, is you don't have that mark-to-market volatility. So yes, you can still have very attractive yields in private credit or access to some of these innovative non-public companies through private equity, but you are going to also experience that daily volatility of price movement in these underlying strategies. And so understanding that first and foremost, I think, is really important.
There are funds now offering exposure to stakes in huge private names like OpenAI, but how can investors know how much that fund's stake is really worth and how much exposure they're really getting?
Yeah, the valuation component is also a big part of the education. As we're thinking about investing through ETFs, oftentimes what strategies will do are will invest in their liquid counterparts. So in the event of, say, private credit strategies that are in ETFs, they'll invest in BDCs or business development companies or even closed-end funds, which is some of these entities that they themselves are investing in the private credit companies. And so it's a second derivative almost of a sort. And so you're not getting that direct exposure. And we like to think about these strategies and ETFs as a proxy. And so anytime you're going to have a proxy for the actual exposure, you might be sacrificing on something. And I think as it relates to private credit in particular, it's really that smooth volatility profile. If you're an investor in private credit or even interval funds, when you're looking at your quarterly statements, there's not a whole lot of volatility. But as we've seen in the last few weeks, if you're investing in business development companies, closed-end funds, or these private credit ETFs, you are going to experience the daily volatility, and that sometimes I think is what scares investors.
We have had a few alarming headlines in the private markets lately: the bankruptcy of car parts maker First Brands Group with huge debt, and the stock prices of asset managers like Blue Owl and Apollo have been sinking. So should investors be wary about the private credit markets?
There was a lot of news, especially mid to late September. I think some of that has kind of fallen to the wayside. If we just look at the performance of some of these BDC companies or private credit ETFs, they've actually performed even better than some of the small cap public equities over the last few weeks. I do think that some of those idiosyncratic events were specific to tariff policy, immigration policy. And again, the media likes to pick up a lot of these headlines, but I do think it's important for investors to understand where the risks are, because for the last few years, private credit has been going in one direction, which is up, up, and up from both performance and flows perspective. And again, to get a 10% plus dividend yield or distribution yield, there is some risk in these strategies. And so what we're looking at is kind of the broader credit space, looking at credit spreads. And there's no real signs of systemic risk, but it is important for investors to understand that there will be pockets where there might be some risks within portfolios.
Are investors likely to see the kind of headline returns they might be expecting from private credit through an ETF?
That's also a really great point. Typically, when we talk about private markets, there's high dispersion. And so if you're told private credit might deliver 12, 13% yield, the actual strategy manager that you invest in is going to give you very different results. I think there's a little bit less dispersion when you come into private credit ETFs in particular, because there's only so many BDCs, closed-end fund companies that investors can access. And so it typically tends to be a diversified basket of these underlying companies that you would access through a private credit ETF. But there definitely will still be some dispersion across strategies, which is one reason that Simplify has thought about how can we help cushion or protect our investors when there are these credit events. And so we apply a proprietary hedge that we have across some of our other credit strategies to help cushion some of that return in a widening spread or weakening credit environment.
That was Paisley Nardini of Simplify Asset Management. Don't forget, you can watch more videos on Reuters.com.